Hello and welcome to this week's What's Hot, which in the UK at the moment is a seasonally inappropriate expression. So let's have a look at what's hot, metaphorically speaking, in terms of the corporate world and company announcements. So as we know, shares are traded on the London Stock Exchange. Itself has listed company status with the ticker LSEG. The London Stock Exchange has been around for some 300 years. Its new strategic partner, Microsoft, has been around for just 47 years. It was founded in 1975. However, Microsoft has a market cap of some $1.8 trillion. The London Stock Exchange, a mere £37.3 billion. However, the pair of them have tied up. Microsoft is now a 4% shareholder in the exchange, and the London Stock Exchange, in turn, will have to buy hundreds of millions of pounds worth of Microsoft infrastructure. So I'm not really getting the shareholder perk element of this tie-up. And I am worried about the glitches that may occur as the exchange migrates to the Microsoft cloud. So keep hold of those bowler hats just in case there is fallout from the cloud. Well, Microsoft has big pockets. It's trying to win regulatory approval for the biggest purchase in its history. It wants to buy Activision Blizzard, the gaming firm behind hit titles such as Call of Duty and Candy Crush. It is offering £56 billion. Okay. This week is a bit miserable for the UK if you're a commuter, and for those of us who are loyal to the Royal Mail. Strikes. I can't. I'm freelance and I don't fancy negotiating with myself because I think that's called schizophrenia. So, Royal Mail. The stock exchange listed entity changed its name quietly over the summer to International Distribution Services plc. Now, normally a name change equals a brand refresh. However, the cost of the strikes so far this year may have cost the company £200 million. So how can a company survive that? I don't think it can. Now, I've already told you that Czech billionaire Daniel Křetínský, the co-owner of West Ham Football Club, controls 22% of the Royal Mail parent company, which I'm going to truncate to IDS. He owns that through his vehicle, Visa Equity. Now, if he takes the company over, new ownership doesn't necessarily mean higher pay for those who are striking at the moment. Well, where I live, the economy clothing shop M&Co has been turned into a bookshop. We've learned that M&Co has gone into administration. Big shame, as this business has been around since 1884. And younger online clothing retailer ASOS is parting ways with its interim Chief Financial Officer, Katie Mecklenburgh. This follows her predecessor, Matt Dunn's resignation at the end of October. So there's a bit of a churn going on there in terms of those who are in charge of the cash. So, movement in the world of fashion, both bricks and mortar and the clicks online. But back to the bookshop that has opened where M&Co once stood. Keep an eye on publishers because Penguin Random House has had its $2.2 billion takeover of rivals Simon & Schuster blocked by regulators, probably after an impassioned plea by horror novelist Stephen King, who was completely against the tie-up. So, if there's consolidation in the air, keep an eye on UK-listed publisher Bloomsbury publisher, because shares in the Harry Potter publisher have recently touched a year high, and we know that the institutional investors are topping up their shareholding. I wonder why. Well, I hope you're well. Stay warm, stay well. I'll be back same time next week.